Welcome to Sand Compounding. Mario Gabelli is a billionaire American investor who has contributed immensely in terms of investing for his shareholders. Mario Gabelli is also founder and running the Gabelli Investment Advisors, and he is a staunch proponent of value investing. Wherever he sees the arbitrage opportunities where he can pounce on and grab a lot of shares in those companies, he has done that multiple times in the past couple of decades. Here are a few investing nuggets from Mario Gabelli which we can learn from. Take a look.
One of the elements is patience. Secondly, you do have to understand that when we buy shares of stock, we're buying a piece of a business. So what is the business worth? From my point of view, I had an accounting background and a philosophy minor, but then when I went into graduate school, I had finance, but in particular security analysis. So I was trained in the Graham and Dodd methodology of valuing a security. You gather the data, that is, you look at all the public information. Then we, as a firm, put it together by arraying it. Then we project, then we interpret, and then we communicate. So we call it the GAPIC approach, G-A-P-I-C approach to investing. So we try to find companies. Now back about 70, 80 years ago, you would try to find a company where you had 1 million shares outstanding, selling at $10, but they had cash or receivables of $12. It was basically finding a company below, in the public markets, below the net current value of their assets. That is very hard to do today. The markets have been reasonably culled over. So you then try to find other businesses where you do this work. The second thing that's important, other than patience, is accumulating knowledge of industries over an extended period of time. So by following the auto industry, as I've done for 40 years or 50 years, and the farm equipment industry and the entertainment business, you can adopt the change quicker. And if the stock market, which we call Mr. Market, comes down as it did on Friday, and today it's because of Brexit, you can see what companies make an interesting opportunity. Are they weak enough? And then how much time do you have to hold? So those are kind of the elements. What we call the private market value with a catalyst, because we would like to harvest and narrow the spread between the public price of a security, what you can buy a company at, and what it would sell to a private equity and or a strategic, that is a corporate buyer. So in that framework, we don't necessarily look at book value. We look at what we call what multiple of cash flow minus capital expenditures, EBITDA minus capital expenditures, would someone pay to own the business? How quickly will that EBITDA grow? How is it affected by inflation, deflation? Is it subscription revenues, or is it a transaction revenue? For example, if you're buying sugar and there's a spike in the price of sugar, somebody's going to make a lot of money, but what multiple would you pay for that as opposed to someone that's buying a cable television cash flow? So that we distinguish that between book value and what the value of a business is, and that value can change over time. For example, if you're doing leveraged buyouts, private equity, what multiple can you sell the business at 5 years from now? What kind of return do you want to have on your equity investment? How much debt can you raise to finance it today, and how much debt can you raise when you want to sell it to somebody else who'll do the same thing? So there are a lot of dots, not complicated, but that's what we do.
Sure. And you mentioned